An IRS audit can be one of the most uncomfortable, most humiliating experiences of your life. The IRS seemingly has unlimited power to ruin you, and often people don't claim all the deductions they are entitled to because of some audit red flag they are convinced exists and wants to avoid. Hi, my name is Anthony Perrin. I've been a tax attorney for the last 20 years, and I have been saving my clients' sanity and fortunes from an aggressive IRS, but I know not everybody can afford to hire my firm. Yet I can't stand seeing the IRS beat up on innocent people, so I don't mind giving away my best tips so that everyone has a shot at tax justice. Now, before we get into these 5 keys, understand the IRS's limitations. These are not the outdated red flags, but these are the red flags for 2025. I want you to understand how the IRS used to work and how things have drastically changed over my career. When I started as a tax attorney, we had an incredible amount of audit clients. The IRS wanted to audit everyone and would truly spread the misery around. But the IRS's effectiveness crashed as their best employees started a mass exodus around 2009 due to retirements. Now, the carnage hasn't stopped, so what this means is the IRS no longer has the staff to spread that audit misery around like it used to. But rather, now the IRS seeks the highest return on investment, or ROI, out of their staff's limited time. So the IRS focuses on easy exams that could result in high tax and penalty bills that only take a few hours of an auditor's time, perhaps minutes. That is the new way of the IRS, which leads me to my first audit avoidance key. The biggest audit red flag is something called the Earned Income Tax Credit, or EITC. Now, look, I know this doesn't affect that many people who watch this channel, but it illustrates how the IRS actually works. The EITC is a credit available to low-income folks with children under 18. Now, Congress created the EITC to help struggling families, so in true government fashion, these are the types of returns that the IRS audits the most. The IRS conducts these audits by mail, and get this, most of these poor people don't read, or if they read, it's at a very limited level. The Treasury Inspector General of the IRS, the watchdog of the IRS, interviewed taxpayers who went through an EITC audit and found out that many of them didn't even know they were ever audited. That's the kind of fight the IRS wants. So, hey, look, the way to avoid this red flag is, hey, don't file the EITC, or if you are, make sure no one else claims your children as well, and make sure their names and social security numbers are correct. Of course, if you are audited, I would recommend hiring a powerful firm like mine to put the IRS in its place, but there's a problem. EITC filers don't have the money or sophistication to protect themselves, and the IRS takes full advantage of this. These easy audits help the IRS build up their stats, and our government doesn't mind using poor people as props to build up an aura of invincibility and impression of competency. Now, that's a big first key, so here's the second one. A serious red flag that affects people usually making more money is Schedule C. If you own your own business, you may be filing a Schedule C with your Form 1040. The reason why you might file one is Schedule C is easy for self-preparation and typically doesn't add too much to a tax prep bill if you hire a firm like mine. But because it is easy for taxpayers, it's also easy for the IRS to audit. So the IRS sticks their examiners on these type of cases. After the Earned Income Tax Credit audits, Schedule C audits are the second most likely type of audit. No question. But the fix is so easy and obvious. If you own a business, I tell my clients, I need a compelling reason why a Schedule C should be filed over an actual business return, which is typically an 1120, an 1120S, or a Form 1065. The reason why is that if you report your income on a business return, your audit risk drops significantly. The IRS won't publish the exact rates, but I have some estimates. The audit risk of an 1120S return is about 10% of that of a 1040 with a Schedule C, and a partnership return, a Form 1065, has an even lower audit risk that is just around 6% of a Schedule C. Or to put it another way, by filing a Schedule C, your audit risk is 1,000 times the audit rate of someone who files a business tax return. The reason is that business returns are more complicated, which the IRS doesn't like to examine. So yes, you will pay more in tax prep, but you will likely pay far less in taxes, as you can be far more aggressive in deducting your legitimate business expenses than someone who files a Schedule C. Additionally, you can avoid the cost, both financially and emotionally, of an IRS examination. Look, it can take years to recover from the damage of the IRS, and that's after you win. Look, it changes you. And the sad fact is some people never recover from an IRS audit. Don't be one of them. Now, what if you already filed a Schedule C in the past? Can you go and fix this? Well, probably not, but that's why you may want to reach out to us now to get you set up for next year. Go to IRSMedic.com/prep. We'd love to talk to you about how to make your business work a little bit better for you. Now, here's the thing. Consider that the wealthy get wealthy and stay wealthy by filing business tax returns in a 1040 without a Schedule C, right? You see that? Lower audit risk and lower taxes are a great selling point with business returns. Oh, and by the way, the vast majority of Schedule C audits are on those making $200,000 or less. I suspect this reason is because people making more will instinctively hire a tax attorney, whereas those who make less may be tempted to save costs by handling the case themselves because they mistakenly believe the IRS isn't out to ruin them, or by hiring some low-powered outfit the IRS doesn't take seriously. Now, here's your third key on how to avoid an audit. Be aware of the foreign income and asset red flag. The IRS loves to assess penalties for not filing certain reporting forms for those with income and assets overseas. The IRS imposes worldwide taxation and assesses truly depraved penalties for not reporting foreign bank account ownership, foreign trust, foreign gifts, and foreign businesses. And the way the IRS penalizes is truly, truly sickening. Remember, the IRS doesn't want a fair fight, right? So they won't go after someone who is capable and has resources, because those are the kind of people who will immediately hire a tax attorney who isn't intimidated by the IRS at all. So the IRS prefers to target older folks whose memory and stamina to fight back aren't as great. For example, if you or your parents have a bank account overseas, the IRS may be able to assess something called an F-bar penalty equal to 50% of the highest account balance in just a few hours of their time. Their ideal target is a widow over 80 with dementia who inherited a bank account from her parents. In just a few hours, an IRS examiner can ruin not just her life, but also the lives of her children and grandchildren. So my advice is, if you have foreign income and assets, or if your parents do, to get a checkup. Make sure that nothing is missing, or if something is, it can be handled before an audit starts. And really, these are the kinds of returns you may not want to prepare yourself, because the IRS knows if you file a return yourself, you do not understand the threat the IRS poses. The IRS wants you unsuspecting and naive and not represented by competent counsel. You can go to IRSMedic.com/offshore if this is something that might apply to you or your parents. And now on to my fourth key. Okay, well, let's just suppose that you took a controversial tax position on 1 year's tax returns. Well, the truth is, it may be suspicious, beyond. It may be a big red flag, but understand this fact. The IRS doesn't want to audit you for just 1 year, but rather the IRS wants to wait until you make the same mistake again in multiple years so they can hit you with the biggest tax and penalty bill possible. It's all about maximizing their ROI. From the IRS's perspective, totally ruining someone with just a few man hours is a great thing. So the point is this: if you are taking advanced tax moves, perhaps not do them every year. And now for my fifth and last key to avoiding an audit. This is a reverse red flag. Not that this may help you in particular, but again, it shows how limited the IRS actually is. 15 years ago, this is how the story goes. An IRS revenue officer who I worked with all the time, really liked him. He's since retired. He was one of the good ones. He stopped by my office to discuss the cases I had with him. And at the end of the meeting, he just says, "Hey, Anthony, I got a question for you." I said, "What's that, Steve?" He goes, how many Chinese American surnames do you see on federal tax liens? I said, you know what? I don't see a lot of Chinese last names on tax liens, and I've seen thousands. Steve said the same thing. He goes, yeah, you're right, I haven't seen it. Well, I'm going to tell you the reason, Anthony. Why is that? Because the IRS doesn't have Chinese-speaking auditors. So the IRS will tend to steer away from auditing them. Chinese American business owners don't get big tax audit bills like other Americans do. So if you happen to have a Chinese first and last name, great news. But if not, don't you see how changing your name to, say, Ming Chen could greatly benefit you? So here's the bottom line. The IRS truly has limited resources and again wants to maximize the damage it can create with its limited staff. Yes, there are new IRS employees, but they must be put on nothing but the simplest cases like earned income tax credits mentioned earlier. And worse for these new IRS employees is that the mentorship that used to be available at the IRS is no longer there. There is often no one to ask a simple question in a cubicle next to them. And when interviewing for the job, the prospective auditors were told that they will examine the rich and powerful who aren't paying their fair share, but in fact, they discover a reality that is the exact opposite. Many of these auditors can't stand what the IRS has become, and these moral people who feel unsupported also tend to be the most competent, in my opinion. They resign due to physical ailments that manifest from the incredible stress that is a byproduct of ruining people who don't have the ability to defend themselves. So, hopefully these 5 keys to avoiding the IRS audit have helped you, and hopefully, if you were considering a job at the IRS, persuaded you maybe not to join them. So what other audit questions do you have? Leave them in the comments below. This is Anthony, parent of IRSMedic. If IRS fear is keeping you up at nights, be sure to subscribe and turn on notifications. And give me a thumbs up if you think I earned it. Thanks for watching and reminding you that just because the IRS can't successfully attack the strong and powerful, it viciously punishes the naive and weakest the most. Go to IRSMedic.com for more.